Welcome to TheoTrade. This is Don Kaufman. It's February 12th, 2020, and you are watching the TheoTrade evening video. About 12 minutes left inside of today's trading session. The S&Ps, come on. Another day, another rally. They're up about 21 handles right now. And we're going to detail a number of sector rotations, a little bit about bonds, a little more about volatility, but what is effectively in play right here, right now. So the number that we're seeing on the screen, and I'm going to go ahead and I'm going to freeze the screen during live trade right now. Right here, that's a critically important number. Why? The S&Ps at this point, along with the SPX, and for those of you that do tune in, day out, I talk incessantly about the expected moves, and that is, what the option market depicts movement to be and how much risk really resides, if you will, at the upper and or lower edge of these particular expected moves. Now, these expected moves are something that we bring up, each and every kind of weekend video, something that I talk about and update you typically on a Wednesday like today. Nevertheless, here we are. We were talking over this past weekend about a $50 expected move, and that's precisely where we're at this moment. Now, to zoom this in all the way to a 1 day, 1 minute chart, this is the SPX. How does it relate to the S&P futures? Well, the S&P futures are the hedge for the SPX. Effectively, they're the risk offset. That's kind of what the hedge means. The SPX, listen, there's no underlying stock in the SPX. You can't trade. See, instrument not tradable. You can't trade the SPX. So if you put on SPX option positions, the offset, of course, is the S&P futures. And here we are sitting right smack on the edge coming into today's trading session. It's the edge of that expected move. It's where, the risk kind of goes neutral, if you will. Now, that number is specifically 3378 inside of the SPX. So for the remainder of the trading week, and this is, I believe, of critical importance, for the remainder of the trading week, yes, we can absolutely unequivocally cross outside, of the expected move. In fact, we have done just that. 1, 2, 3, 4 weeks in a row, we've actually cracked outside of it. However, we still have an incredibly strong probability of closing at and or below that 3378 level. And I want to reiterate that even though we've seen, again, 4 breaches of expected move, listen, there's absolutely no question, that we're, right now we're cresting outside of it. Remember, the expected move, is not spot on. It's not definitive. It's not like this line will stop the market. You're not using this, like a resistance of some, of some type. This is, for the most part, where a lot of trading firms go into this without too much detail. It's kind of what they term like the gamma neutral. Everybody is okay as long as we're sitting at 3378, but you get outside of it, and the markets can really start to heat up. In fact, as you get outside of these expected moves, you'll literally see the market start to kind of heat up. Again, I want to reiterate that this week is far from over. We've already moved 50 points to the upside, and I'm telling you, it's far from over. You can go ahead and take a look at all the volatilities you want. Just between now and Friday, they're only pricing in $22 of movement. I would buy that all day long with both hands. What that means, when I say I would buy that all day long with both hands, we still have Thursday and Friday to go through. They're only pricing in a $22 move. When I say I want to buy it, I mean, in effect, I think we can move a lot more than $22.48. But again, the higher probability trade is to stay inside, inside of that expected move. Remember, we had 23 weeks in a row inside the expected move, only to see breach. Right now, again, here we are on a Wednesday breaching the expected move. But hey, the week is still young. You got Thursday, you got Friday. Even if we do cross outside of that expected move, many of you may have on, okay, that callback ratio spread, which was a portion, okay, of our infinity spread. That's a pretty good hedge for a marketplace that just keeps driving higher, all-time highs. Now, let me move a little bit past the SPX. I think you guys get it in terms of expected move. All right, other aspects, okay, that are in play. You've got, again, the monsters of tech, your Microsoft, your Apple, your Facebook, your Amazon, your Google. So they're still just charging forward right now. And they are unequivocally lighting up the Nasdaq along with it. But one of the interesting things that I found specifically in trade today, and I kind of talk about this incessantly, is the trade of the financials, okay, against the monsters of tech. And if you're not comfortable with the idea of the monsters of tech, which is Microsoft and Apple and again Facebook and Amazon and Google, that's what I call the monsters of tech. The monsters of tech are just lighting up the screens. That's where I'm saying another rally, another day. They just keep pressing forward. Today, though, very interesting. It's a sector rotation. By a sector rotation, let me actually take you specifically to it. This is the XLK versus the XLF on an intraday basis. And I want to reiterate that. Again, I used the XLK technology, right, versus the XLF, which are the financials. Now, if you're not comfortable, the XLK is too technology, I don't care if you want to use the Qs, okay? Go to town. Just go to town. That's just fine, right? Just make sure that you put on, okay, today. And if you really want to kind of modify this, you can actually come in here and say, hey, just show me, all right, the market open. And what I wanted you to see in this particular case, this is critical for trade, all right, right here, okay, is the XLF. The financials rip out of the gate and come down and kind of flatline. What did you see out of tech? The exact opposite. They dipped, ripped, and kind of flatlined throughout the course of the day. What we're getting is, again, there's sector rotations out there, and it is critically important to understand, okay, that in terms of order flow. So if the financials are really not producing, okay, any positive momentum to the upside, it is very likely, okay, and should stall out the S&Ps, okay, in the days to come. Now, what can happen over here? Well, sure, the financials can, catch fire. They could start rallying again tomorrow. But the financials are to be watched very carefully. As I said, if the financials do not participate in the upside, you're going to stall out the rally. So why is the market up 23 handles today? Because, all right, we actually have what's playing in here, the energy sector. The energy sector is kind of the odd sector out lately. This thing hasn't been able to, to catch a bid to save its life. And here we are, the energy sector up 1.5%. We're looking for a little bit more of a bounce, by the way, inside of the energy sector before we might step in and go ahead and short it. Nevertheless, it's the energy sector coupled with technology that actually drove the S&Ps, okay, up 20. Once again, I want to reiterate something that I talked about recently. You may see the S&Ps up 20. You may see them charging forward over here. Take all of this, okay, with a grain of salt. You are seeing volatility, okay, to the upside in this market. You almost have to, again, redefine what you think volatility is. I also want to reiterate the bonds, okay? Do you see the bonds selling off in the midst of some of the rally that we're seeing right now, okay? I will continually pound this home. It's a rally, okay? Absolutely. It is an incredibly dangerous rally. As many of your risk kind of assets, specifically the bond market, it's not really backing off. And if the bond market's not really backing off, okay, there's some traders afraid. Now, volatility, and you start looking at the VIX, this was a real move down today in the VIX. Come on, the VIX, that's, it's ancient. It's not even worth looking at anymore in terms of volatility. Why? The VIX can't even see what's going on in short duration. For those of you that don't know the VIX, okay, the VIX cannot even measure any of the volatility, okay, in a shorter time frame. First of all, the VIX is 30-day volatility. Any shorter than about 9 days out isn't even in the VIX equation. If you want to look and see what volatility is really doing, look at the volatility of the volatility index. And interestingly enough, it's going to remain flat today. We have a VVIX, that's the volatility of the volatility index, okay, that's almost at 100 with a marketplace effectively at all-time highs, with bonds, okay, just a hair off of all-time highs, with financials kind of waning on a trading day. This, okay, is not necessarily what rallies per se are made of. And again, that's why I say take the fact that the S&Ps are up 20 with a grain of salt. There's no question the Nasdaq is absolutely charging forward over here. But once again, okay, a very dangerous situation that we're seeing kind of, and a little perplexing, if you will, in terms of sector rotation. The last aspect that I want to leave you with, okay, is the Russell. Okay, and it's not every day that we bring up the Russell, okay, but the Russell has also been charging forward in this particular rally. But I'll also remind you, the Russell, okay, is well off still its all-time highs. And we keep talking about markets charging forward, all-time high, all-time high. The Russell is still significantly off of it. Nevertheless, and the reason I'm actually bringing the RUT into the equation over here, its volatility is still high on a relative scale. With that, I want to thank you guys for joining us here at TheoTrade. Listen, these sector rotation, this is what good trades are made of. Have a great night, everybody. Bye-bye.